Welcome everyone, I'm Benoît Lallemand, Senior Research Analyst at FinanceWatch, and we're pleased to have you today for this presentation. The topic today is going to be high frequency trading. There are several reasons why we think it's an important topic. The first one is that high frequency trading has become a major feature of financial markets over the last 10 years. The second one, related to the first one, is that regulators all over the world, and in Europe in particular, are discussing ways to catch up with a practice that is today still largely unregulated. And there's been a number of concerns concerning its impact on the quality of markets, on investors, and more generally on society. So you have in Germany, in France, at the European level as well, in the US, in Asia as well, concerns from regulators and lively discussions on this topic. So we want to try and explain to you in a few words what is the context of this discussion. Two important things before I begin. FinanceWatch is supportive of a financial industry that serves society, and to be sustainable, this industry has to be profitable. So we don't only think it's legitimate, we think it's necessary that the financial industry makes profit to be sustainable. The second element is that we support technological evolution, again when it serves society. And as a matter of fact, most of us have in our pockets mobile devices of which a computer chip would have filled up an entire room only a few decades ago. So we're completely fine with that. Okay, so now the background of this whole discussion is obviously the structure of financial markets. So I need to give you some context here. Basically, there are two. The financial system could be split in two large parts. One is the banking system, and the other one is financial markets. So the banking system on one side, you have deposits from savers. We call it an intermediation model because you have a bank in between that collects the savings on one side and then allocates them to basically people who need capital, be it corporations, individuals, or states. And then on the other side, you have financial markets, which we call a disintermediated system, where savers and people who need capital are connected directly with one another without the intermediation of a bank. Now, there are different types of capital markets. Basically, you have three types. You have the stock market, you have the bonds market, and then the derivatives markets. Today, we're really going to focus on stock markets. But a lot of what I'm going to say, at least when it comes to high-frequency trading, could be actually said as well about bonds and derivatives markets. So now focusing on stock markets, one of the characteristics of stock markets is that when you buy a share in a company, you do have a little more risk. It's a more risky investment than when you go and, for example, put your money on a bank account, or even if you buy some bonds of a company where you know in advance the sort of interest you're going to receive every 6 months or every year, and you know as well that a few years from now, 5 years or 10 years, you're going to receive your capital back. If you buy shares in a company, basically you're never going to receive your money back. You own a share of the company, you receive dividends maybe, or maybe if the company does not do well, you don't receive dividends. And so basically a very important feature of these markets is that you should be able to liquidate the assets, so to sell the asset at some point to another investor if you need the money back. So if you need to buy a house tomorrow, you need to be able to sell some of the shares that you had bought. And that is why there is what you have heard of as secondary markets. So it's very important to understand that the secondary markets, as the word says, is really the occasion market where people can actually sell the shares they have bought if they need the money. So you have the primary market where actually investors and corporations meet. So the first investors give the money to corporations, and then you have the secondary markets where investors only then can exchange the assets. And because these assets are a bit more risky, you need these stock exchanges, which are really platforms on which investors and corporations meet on the primary market, and investors and other investors meet on the secondary markets. You need these platforms to offer transparency, order and stability, and fairness. If you don't have these values, then basically these markets might scare a lot of people away because of the riskiness of these investments. So the transparency is basically to ensure that people understand how the system works and that the prices that are offered are built in a transparent manner. Order and stability relate to the fact that the whole system should not fall apart every other week, and that it's not conducted with abusive practices as well. And lastly, fairness will guarantee that everyone is treated equally. So these values are really important. And just to finish on this, if you go back to the banking model and financial markets, you should have in mind that in the UK and the US, typically the economy is financed at 70%, so a large majority by financial markets, where on the continent in Europe, the tendency is more that only 30% of the economy is financed by financial markets, and banks account for the very large proportion of financing the real economy. Now, linked to what I just said, in 2006 you have regulations called MiFID in Europe and Reg NMS in the US, basically based on the principle that we should, especially in Europe, develop financial markets, amongst other in the context of the Lisbon Agenda, where the aim of the European Union was to become the first economy in the world. The assumption was that you needed a lot of funding to finance economical growth, and that this funding could not only come from banks, but also should come more and more from markets. So, to develop financial markets as other services, the recipe at the time was competition. And so competition was introduced in the field of stock exchanges, with the assumption that it would reduce costs and it would attract more people to these markets. Now, what's important to keep in mind is that we are talking about secondary markets. And so this theory that the more trading there is, the less costly it is for corporations to raise capital, actually, was challenged in the past. If you look at, what people like Keynes said, they actually argued that the cost of trading should remain high, so that it would not attract what he called speculators, which are people who buy and sell all day long to try to make a profit out of the price differences, but rather that the cost of trading should be high, again, to actually incentivize the long-term investors, which are really the one that corporations want to have as shareholders. Now, as a result of this competition, of course, many new actors came into the marketplace, so new stock exchanges. Most of them actually only focused on the business of secondary trading, so they did not want to go into the primary market business, basically because it's less profitable. Though the old national monopolies were forced to compete with new entrants, they became for-profit companies. And the primary function that they have, which is really to help investors in company to meet in one place, ensuring that you have stability, security, fairness, etc. This function has gradually become secondary because it's not the most profitable part of the business. And stock exchanges have focused on their most profitable clients, and these clients are the high-frequency traders, because they need very specific and expensive services to be able to run their business, such as co-location of their machines in the building of the stock exchanges, very fast data feeds, etc. And so gradually you have a disconnection from the real economy purpose of these markets and the needs of these traditional investors with the reality of the markets. Now, what is high-frequency trading? As I mentioned, it's important to understand that it's really the introduction of competition and the deregulation of stock exchanges that gave rise to high-frequency trading. Technology plays a part. There was a technological evolution, but the practice as we know it today would not have been possible if you did not have this deregulation, even if the technology was available. And one of the reasons is that the cost of trading used to be higher, and that you cannot trade every other millisecond if each time you have to pay a cost that is too high. Now, as you see on the slide, the proportion of high-frequency trading has been dramatically rising. It is actually more stable now, but still at a very high percentage of the total of activity on these markets. Continuing to illustrate what high-frequency trading is, as I said, speed has become the main advantage of a trader today, and trading is actually very, very fast. So to give some sort of image, if it takes on average 350 milliseconds to blink, actually around 5 to 7,000 transactions can occur on markets in that time. It takes more or less 5 microseconds, so a millionth of a second, to complete one transaction. Another illustration is the fact that not only you need fast computers, you also need data to be transported as fast as possible in between marketplaces, because these markets are global, and so you want to make sure that your orders reach different stock exchanges all over the world. So you have actually new cables being built under sea or above sea level to make sure that the data is accessing stock exchanges as fast as possible. Now this slide illustrates the fact that today's algorithmic ecosystem is simply not accessible to the human decision ecosystem. So basically the human brain has some limitations in terms of speed that forbid it to grasp what is going on in today's algorithmic ecosystem. So you have, I'll let you look at some of the examples of the timing it takes for the human brain to compute information, and you see, if you look at the microsecond level, which is really below the millionth of a second, that we are clearly remote from the abilities of the human brain. Now we're going to go to some of the problems related to this evolution of stock markets, and the first problem is actually related to partly to what I said with the fact that we are detached from the human decision ecosystem. It's disorder. So there are two main reasons for these what we call mini or super fast crashes these days. The first one is linked to what I just said, and the fact that you have algorithms or robot traders trading against each other, and it's very difficult to predict the behavior of these robot traders once they interact with each other. So you can program very clearly one and the other, but then when they start to interact and you have several of them interacting, it's always more difficult to foresee the result of these interactions. The other reason is simply that stock exchanges frequently reach their technological capacity. So because there is more and more speed and more data flowing into their systems, you need to frequently update the IT systems, and sometimes it will happen that the system runs out of capacity and blocks. The second main problem is the fairness of these markets, or rather the unfairness. So you always had faster traders, or traders who had more information, and who would take advantage of that and take advantage of slower traders. So these days the advantage is on a scale that's just never seen before. So there's the fact that these computers give access to speed and to the ability to place a number of orders that is completely out of reach out of traditional investors. But you also have the fact that some of the services that stock exchanges provide are just not accessible because they are so expensive to traditional traders. Now exchanges will tell you that these services are democratic because actually they're open to everyone. We would argue that then a Ferrari is a pretty democratic car as well, because nobody's forbidden to buy it. Just another point on the fairness of trading and actually the cost of trading. We have mentioned that due to competition, the cost of trading has gone down. So that is the fee you pay each time you buy or sell a security. But what is very important to understand is that because the size of these trades has gone down, the total cost of trading has actually gone up. So in fact, competition did not really work. The last problem, and maybe the most important, is the lack of investor confidence in these markets. So there have been signals from the markets that that confidence is degrading. Now it is due in part to macroeconomic factors, but it's also due to the frequent technical glitches on these markets. So you've had problems with the Facebook IPO, the BATS IPO, you had the flash crash, and you have a number of mini flash crash which are getting more and more frequent. It's also due to the perception of traditional traders that high frequency trading, as I said, includes some unfair practices and in some cases abusive practices. So what we ask for is regulation of these markets that ensure again that we have stability, we have transparency, and we have fairness, and most importantly that would restore investor confidence. Now Finance Watch gave evidence in Germany because a law on high frequency trading is going on. We gave evidence as well in France, where some similar progress is being made on the regulation of high-frequency trading, and we are following the file in Brussels as well. It's called MiFID II. It includes a lot of topics, and one of these topics is high-frequency trading. So we will be following up on these topics.